Hi, this is Jason, Chief Technical Analyst with Toro Alerts with your weekly market update. We've got quite a few charts to get into, so let's go ahead and jump right into the charts. The first one we're taking a look at is the SPY. We're seeing some selling pressure recently in the SPY, and we're definitely right around some key support right now. So next week, if we don't see an invasion with Russia, I'd say there's a pretty decent chance of a possible short-term bounce. But obviously, if we continue to see the geopolitical tensions ramp up, then it wouldn't be surprising to see a bit of a sell-off. And if we do get a sell-off, from looking at a variety of different charts, it looks like there's a pretty solid floor right around a 10% sell-off, which would be around the 390 level on the SPY. So that's a key level we'll be looking for. If we see continued selling pressure, we want to see a bottom form there around that 390 level, and if that holds, then that might be a great buying signal to buy that bottom in the SPY. And taking a look at the Nasdaq, the triple Qs, same story, a lot of selling pressure up against a key support level, so we'll want to watch that on Monday and see if it holds, but if it doesn't, it continues to break down. It wouldn't be surprising at all to see the Nasdaq continue to sell off, and would really be looking at additional selling pressure above the SPY. The SPY is probably only looking at about a 10% decline in the short term, and really the Nasdaq could easily be a 17-18% decline to this key Fibonacci support level, which is down at around 281.50. Dow Industrial Average also seeing some selling pressure, but also, like the other two charts, hanging out right around some key levels of support. We'll see if that continues to hold. If it doesn't, we continue to see some selling pressure as well in the Dow Industrial Averages, and we could see it get as low as maybe about 310, 315 on the Dow Industrial Average. Dow Jones Transports sitting around for the last 4 weeks below the 50-week moving average, so that's definitely a bearish signal we're looking at in the transports. Granted, they haven't been selling off super aggressively, but they also have not been getting back above that key moving average support. So until we get back above those levels, it's not looking like the transports have a lot of upside. Another key chart I've been looking at really closely is the Russell 3000. That's a really interesting chart because typically when we go back all the way to the 2008 financial crisis, we've seen that in this chart, once we get below this 50-week moving average, we tend to see a sell-off to about the middle of this channel, and that would be this yellow line right here. And so if we do continue to see selling pressure out of the broader markets, and that's telling me that we could easily be looking at about a 10 to 12% sell-off in the broader markets at large. And if that sticks and holds there, then that would be also a potential bottom in the markets. And if we can see this potentially hit this trend line, as well as some of the key support levels around the Nasdaq and the SPY all kind of correlate together at the same time, then that could be a really strong signal that the bottom could be in, and it could be a great buying opportunity. Taking a look at the Russell 1000, the large caps were below the 50-week moving average there. We got back above it the last couple of weeks, but then that broke down and sold back off. And so as long as we're below that 50-week moving average, that's a pretty bearish signal for the large caps. And so both large caps and small caps are struggling currently. Taking a look at the small cap chart, we've had multiple attempts in the small caps trying to recover and find a bottom. We had about 3 or 4 weeks really where it came up against some pretty key trendline support, and it did not get through. So it really found resistance around that 204 to 205 level, and it tried to get back up even to that other resistance level right around 209 and failed. And so anytime you see these candlesticks attempt to get up to these key support levels and then fall off of those, that's typically a pretty bearish signal, and we've had 4 weeks of them so far. And so it wouldn't surprise me to see small caps roll over and continue to sell off in the short term. Taking a look at the Value Line Geometric Index, that's about 1,700 different stocks represented, which gives us a great indication of the broader health of the markets. This is a pretty key trend line support here. We've been bouncing around at those key levels, got back above them recently, but then just this last week broke back down. And so if we're below this trend line on the Value Line Geometric Index, that's also another bearish signal for the broader markets. If we take a look at IWF divided by the IWD, that's growth versus value. And so when our chart's going up and to the right, the growth sector typically is outperforming. And when we see this chart start to sell off, that means value is the place you want to be. And so as you can see, we've been sitting at really about mid to late November when it rolled over, and value has definitely been the place to be over growth since that's occurred. Taking a look at the relative rotation graph, I like this chart a lot because it shows us a different viewpoint on some of the key industry groups. And I've also added a few this week that I don't normally have in there just because we've seen some interesting developments in metals and miners, gold and silver. And so you can see on this chart that the metals and miners have really outperformed the broader markets with about almost a 20% return in the last 15 trading days. We've also seen gold and silver do really well with 6 and 6.8% returns, and they've moved into the leading quadrants. And so those are some good bullish signals in those sectors. And so I definitely would be looking for some opportunities in gold and silver as well as the metals miners too. We've seen financials still continue to hold up fairly well, but the returns have diminished as of late. And also energy. Energy is actually in the weakening sector now, but is still presenting some decent returns. And I think that weakening sector in energy is really more short-lived, and it'll likely get back into the leading sector in the near term. We're also seeing some developments in sectors that we kind of expect when we start to see stocks start to sell off. Sectors like utilities and consumer staples tend to do better in a risk-off environment, and we're starting to see those getting into the improving sectors and starting to show some possible performance in the future. Take a look at the U.S. oil charts. We saw a peak the previous week at around $94, $95 a barrel. Got slightly above it this week, but then sold off and finished off at around $92 a barrel. A lot of uncertainty around geopolitical events with Russia and Ukraine, a possible Iran deal that would actually increase the oil supply for the world. All of these are uncertain, really hard to bet either way, against either for or against oil right now because of those factors. And so normally that could be a potential tactical short here, being at the top of this trading channel. But because we've got a lot of uncertainty right now that will likely impact oil prices, I think the best trade on oil is just to kind of hang out and let those develop before we make any further decisions on energy stocks or oil. And if we jump over to the all-world index, excluding the U.S., to take a look at what's going on in the rest of the world, we can see that we're hanging out right above a key trendline support here. We want to see it hold and stay above that if we're going to be bullish outside of the U.S. If it breaks down below that level, that would definitely be a bearish signal, and this definitely looks like it could be a topping pattern. And so we want to keep an eye on that. But if we're above this key trendline support on the EU index, then that could show that we're actually looking like there's some opportunities in emerging markets and outside of the US. And if we actually take a look at a chart showing the EEM divided by the spider index, then we're seeing that we've actually broke up above a key trendline support that we were at a few weeks ago, but then broke down. If we can confirm that next week with an additional candlestick above that key trendline support, then that would be a potential bullish signal on emerging markets and other opportunities outside of the U.S. for potential trade opportunities. Taking a look at the commodity index, that's continuing to do well. It's definitely slowed down. We're not seeing these huge moves on a weekly basis like we were in the previous few weeks, but we're still seeing a pretty bullish movement in commodities, and it's definitely been an excellent space to be allocating capital to. Let's take a look at some of the ratio charts. RCD divided by RHS. So we've got consumer staples and consumer discretionary. When consumer discretionary is a risk-on sector, and when that's going up, then we're going up and to the right in this chart. When consumer staples are getting more bullish, then the chart sells off. And so we're at a key support level here, and we've had about 3 or 4 weeks of attempts to get back above the support line. And if we got above that, then that would be pretty bullish for risk-on assets. But because we keep failing and have been rolling over, if we see this continue to sell off, then that would be a pretty bearish development and confirming that we see some broader selling pressure in the markets. About the only chart I look at for market health is that's not looking terrible right now is the Aussie dollar, Japanese yen. Aussie dollar is typically a risk-on currency, whereas Japanese yen is a risk-off currency. And with that chart, we're kind of stuck trading in a range, and so I wouldn't really say this is bearish or bullish. We're just kind of stuck in between these ranges, and we've been there really since February of last year. And so if we were to break down below some of these former lows, then that would certainly be a bearish development, but otherwise Aussie dollar, Japanese yen is sort of indifferent as opposed to any clear market signals. If we take a look at the high yield corporate bond ETF, that's a great signal for market health. Anytime we're below all of these moving averages on the weekly candlesticks, that's typically been a bearish signal for the markets, and as you can see, we've been below that level for about 4 weeks now. We did hit a key support line here and held that, and so we want to see if that holds or if we continue to sell it further. If we sell off below this line, I would think that's even a stronger bearish signal for the markets abroad. And also another one, if we take a look at that same chart, only as a ratio divided by the IEI bond. So we've got corporate bonds versus traditional bonds, and if we've been trading those in a pretty tight range here since February of last year. If that level breaks and we get below that 0.65, 0.66 on the ratio chart, that'd be a very bearish signal as well, and we could expect some more selling pressure in the markets. We've seen some developments on the interest rates this week. So the US 2, 10, and 30s have all kind of looked like they're forming a bit of a short-term top and have all sold off a bit. We peaked out at around 1.65 on the 2-year, and now we're back down to about 1.47. US 10-year got above 2% for the first time in quite a while, but we sold back off and closed below that level at about 1.94%. And our US 30 interest rates sitting at about 2.25%, still kind of trading in this range, but it also kind of hit that top end of that support line and sold off. Taking a look at the yield curve, US 10 minus the US 2, we're seeing that's continuing to drop. If that were to get to lower levels down around the 0 line, that typically is a pretty bearish signal and a sign of a possible recession. We got quite a ways to go before we hit that, so we're not really worried about that quite yet, but this is another key support level right around the 0.38. So if we hold that, that'll look really positive for the yield curve. If we see it break down below that, then we'll want to be watching really closely to see if we get down to that 0 line, signaling a possible recession. Taking a look at the tips divided by IEF chart. So this basically, when this chart's going up and to the right, it tells us that we should expect increasing interest rates. But as you can see, we've kind of got stuck into a range after we had a pretty strong move up, and now we're kind of just trading in a pretty tight range here. And so that's also another factor that tells me that we likely are looking at a possible short-term top in interest rates for the time being. Taking a look at the dollar index, nothing super interesting happening here. We've basically been trading in a range of about that $94, $95 range to the $97, $75 range. As long as we're in between these two trend lines, I'm not really expecting any major developments. If we were to break below or above those lines, then that would obviously be a bearish or bullish signal, depending on what we see develop there. As we discussed, we've seen some action out of gold and silver. Gold has clearly broke above this wedge pattern here, and it's also got above a pretty key support resistance level at around 174.50. So I've been very bullish on gold recently. It looks like we've got some opportunities to trade off of that, and it looks like there's definitely some good opportunities to look at in the gold and gold miner space. Silver's also looking good, and as the RRG graph showed, we did see some profitable trades out of that over the last few weeks. But we are still trading in this wedge pattern here, and so I'd really like to see us break above this wedge pattern before we get super bullish on silver. But silver tends to follow gold, and so it wouldn't surprise me to see that break out here in the near term. Taking a look at the put to call ratio, we're definitely seeing elevated protection in the markets. A lot of people protecting against downside risk. Anytime these charts are up and to the right, then that's typically that's always a signal that people are buying a lot of protection in the markets, and so it's at a pretty elevated level. As you can see, we haven't been there too often, and there's definitely a lot of fear in the markets right now and people buying protection. VIX is also pretty elevated, hanging out in between 25 and 30, right around 27.75. Got almost a 30 this week, but it came back a bit. Obviously, if we see an invasion of Ukraine, I would expect the VIX to get well above 30 again and some continued selling pressure. But it's really going to come down to how these geopolitical events turn out, I think, over the next week or two to really see where the VIX goes. But it wouldn't surprise me to see it get above that 30 line again in the short term. Let's go ahead and wrap it up with one of our trades that we've done recently. So I've been pretty bullish in the energy sector for quite some time now. And so on my custom portfolio on the Toro Alerts app, I've got a lot of energy stocks in there, and I just got a buy signal not too long ago. I believe it was February 9th was the last time I got a buy signal on this stock, ticker VET, Vermilion Energy. And so just in 10 days, we've had almost a 10% gain off of that stock. I did see some selling pressure the last couple days, but it's stuck the landing here nice at this key trendline support. And so as long as that holds, I think that's looking pretty bullish, that this will see some continued upside opportunities. And as you can take a look at the chart, it really has been whipping, back in August of last year, we were trading at $5.50 a share, and now we're at 17. So we've seen some really nice movement out of this stock, and it would not surprise me to see some continued upside in Vermilion Energy. Nice thing about Toro Alerts app is you can download on the App Store, and we will do all the work for you. We'll tell you when to buy and sell these stocks so that you can get in at the right time and get out before it rolls over. Make sure to take advantage of our promo code so you can try it out free for the first month. Thanks for tuning in, and we'll see you next week.